ever had a foreclosure hit your credit report, there's a good chance the bank made serious legal mistakes and you don't even know about it. Most people just accept it, thinking there's nothing that they could do. But what if I told you that underneath 6 powerful federal laws, the Fair Credit Reporting Act, Fair Debt Collections Practice Act, Equal Credit Opportunity Act, and Fair Credit Billing Act, as well as the Fair and Accurate Credit Card Transaction Act, and last but not least, TILA, a foreclosure might have been reported illegally. In this video, I'm going to walk you through every single violation and mistake a bank can make when reporting a foreclosure on your credit report, and how you could spot them, dispute them, and potentially even get them removed. This isn't some clickbait video. It's based on real legal standards, real court cases, and real consumer protection laws. So grab a notepad because we're going to break them down law by law, backed by real world examples. So let's dive into it. So what is a foreclosure? Before we jump into legal violations, let's break down what a foreclosure actually is and what it isn't. Foreclosure is the legal process by which the lender repossesses a home after the borrower fails to make a mortgage payments in this case. It typically begins after 90 days of missed payments. The lender will issue a notice of default, then a notice of sale, and eventually schedule an auction or take legal possession of the property. But here's the key. Foreclosure doesn't always mean the same thing for everyone. There are alternatives, and those alternatives are often misreported on credit reports, which is where your legal rights comes in handy. Let's talk about 2 of the most common alternatives to foreclosure: the short sale and the deed-in-lieu of foreclosure. A short sale is when the homeowner sells the property for less than the remaining balance of the mortgage, with the lender's approval, of course. In exchange, the lender usually agrees to forgive the remaining balance, then often reports as settled for less than full balance. But sometimes they're wrongly coded as foreclosures, which can tank your credit. A deed-in-lieu of foreclosure is when the homeowner voluntarily gives the property back to the lender to avoid going through the full foreclosure process, which is pretty hefty. It's basically saying, here's the house, you take it, we're pretty much even Steven. So why does it matter for your credit report? Because how these are reported can make or break your ability to bounce back. A foreclosure will hit your credit report really hard, probably about 100 to 160 points. But a deed-in-lieu, when negotiated properly, can help avoid that. It may show up as settled, paid in full, less than the full balance, or even disappear entirely if the lender agrees to not report it. If it's reported as a foreclosure instead of a deed-in-lieu, that's potentially a Fair Credit Reporting Act violation. You can dispute it, plus the lender waives the deficiency balance, the leftover amount owed after the property is returned. Then that needs to be reflected correctly on your credit report. How many times have you guys actually done this? Make a note to self to do that after this video or during. Any misreporting here gives you major grounds to challenge the account. In short, alternatives like a deed-in-lieu don't just stop the foreclosure, they can actually help you strategically repair your credit faster, just as long as you know your rights and know how to hold the banks accountable. Okay, now that we got that out of the way, this section is going to speak explicitly on the intricacies of your consumer rights. And if you remember earlier, I mentioned 6 of them. Here's a test. If you've been following me in this video so far, can you remember at least one of them? Okay, it's all right if you forgot already. I'm sure that if you can stay for this entire video listening to me, you'll never forget. Let's start with the biggest one, the Fair Credit Reporting Act, or FCRA. Under FCRA, banks and lenders must report accurate, complete, and timely information. This means if they report a foreclosure, they better have details exactly right. And here's where they mess up. First, accuracy. Banks are not allowed to report a foreclosure that didn't happen. That sounds obvious, right? But I've seen clients who've had short sale or a deed-in-lieu reported as a full foreclosure. That's not just wrong, it's illegal underneath the Fair Credit Reporting Act. Second, the dates matter. The Fair Credit Reporting Act says negative information like foreclosure can only stay on your credit report for 7 years. And that clock starts ticking from the first missed payment, not the foreclosure date itself. So let's be sure of that. It's the first date of the missed payment, not the date of when the foreclosure started. So if a bank updates the date to make it seem newer than it actually is, that's called re-aging the debt, and that's a violation of the Fair Credit Reporting Act. Number 3, disputes. If you dispute a foreclosure entry, the bank has 30 days to investigate and respond, with a leniency of 15 days on the federal level. But if you are in the state of California, which I am now, that goes down to 30 days by using what's called the California something, we'll go on that later. It's a state agency which I'll make another video later about. The bank has 30 days to investigate and respond, and during that time, they must flag the account as disputed and potentially even temporarily removed off your credit report. If they don't, that's another Fair Credit Reporting Act violation. I've seen lenders ignore disputes completely, sometimes even keep reporting info as verified when it wasn't. That's a lawsuit waiting to begin. Fourth, context and completeness. A foreclosure report must include crucial details, like if the loan was discharged in bankruptcy or if the consumer isn't personally liable anymore. Leaving that out can be considered misleading. The Fair Credit Reporting Act expects not just accuracy, but integrity. It's a big difference, right? Number 5, notice of negative info. Thanks to the FACTA Act, Fair and Accurate Credit Card Transaction Act, which amended the FCRA, lenders have to notify you within 30 days when they report the negative account, like into a foreclosure. That notice might be buried in a mountain of paperwork somewhere. So if you're lucky, you could use that to your advantage. But if they never gave you that heads up notice, it's a compliance failure. And regulators can fine them for it. Let me give you a real world example. During the 2008 housing crash, a lot of short sales were inaccurately reported as full foreclosures. That coding error cost people their ability to buy new homes for years. It led to lawsuits, regulatory action, and a complete overhaul in how these things are coded. Bottom line, there's a foreclosure on your credit report. Fair Credit Reporting Act gives you serious firepower to challenge it. Bottom line, if there's a foreclosure on your credit report, FCRA gives you a serious firepower. FCRA gives you serious firepower to challenge it, especially if something looks a little bit off. The law gives you the right to dispute, demand, and investigate, and sue if they don't fix it. Now let's talk about the Fair Debt Collections Practice Act, another common one, or FDCPA, an abbreviation of that. This law doesn't apply to the original lender, but it kicks in the moment the debt collector or law firm is handling the foreclosure or any post-foreclosure debt. Here's what they're not allowed to do. First and foremost, no false misleading information. That means they can't report a foreclosure balance that's been discharged or settled. They can't say you owe the full mortgage if your home was sold at auction. They also can't act like the foreclosure happened if it really didn't. That's misrepresentation, and it's illegal. Second, disputed debts must be marked as disputed. If you tell a debt collector, I don't owe this, even verbally, they must flag that account and dispute it if they report it to the credit bureaus. Failure to do that, that's a violation underneath Section 1691E, Subdivision 8. The courts have ruled very clearly on this. The third, no harassment through credit reporting. If a debt collector threatens to wreck your credit unless you pay, even if they know the debt is inaccurate or old, they're breaking the law. Reporting false info to pressure payment is considered coercion. Here's an example. A borrower disputes a foreclosure deficiency balance. The collector keeps reporting it without noting the dispute. That's an FDCPA violation. And yes, you can sue over it. Bottom line, if a debt collector is involved in your foreclosure process, you better believe they're held to strict standards. If they cross the line, the FDCPA gives you real legal muscle to fight back. Now let's talk about a law that most people don't associate with foreclosures, the Equal Credit Opportunity Act. The Equal Credit Opportunity Act, this law is about preventing discrimination in credit. That includes lending decisions, servicing, and how a foreclosure is handled and reported. Let's break this down. You can't treat borrowers differently based on protected characteristics like race, age, gender, marital status, or public assistance income. That means a lender can't be stricter with credit reporting for one borrower versus another just because of who they are. If reporting a foreclosure more aggressively for certain groups or fail to fix errors for one borrower but correct them for another, that's a potential discrimination. Second, adverse action notices. If a borrower requests a loan modification and the lender says no, that's considered an adverse action. Under ECOA, the Equal Credit Opportunity Act, they must send you a written notice explaining why. No exceptions. If they didn't, that's a violation. And keep in mind, they have to prove this as well. Remember, they have to prove this. We're using all of your rights to get this thing off. Now, this happens a lot. Borrowers apply for help and get denied, but never receive that formal denial letter. The law says they must get it within 30 days. It's a protection most borrowers never realized they had. Third, joint accounts, spousal credit reporting. If both spouses are on the mortgage, the foreclosure must be reported under both names. If it appears only on one spouse's credit report, that's a mistake. If they report it under a spouse who wasn't on the loan, that's even worse. That's a mix of using the FCRA and the Equal Credit Opportunity Act. So the bottom line is, ECOA is about fairness. If you were denied assistance, treated differently, or had credit info misreported because of your marital status or identity, this law can give you leverage. The FCBA mostly covers credit cards and open-end credit accounts like HELOCs, not traditional fixed mortgages, but it still matters in a foreclosure because if the foreclosure started because of a billing error on something like a home equity line of credit, or if the bank misapplied your payment and reported you late, this law protects you because it's underneath the FCBA. When you dispute the billing error in writing, the lender can't report you as late or take collection action, including foreclosure, while the dispute is still unresolved. So if your servicer misapplied a payment or charged a bogus fee or fees and you raised the issue, but they still foreclosed anyway and it reported, that's a problem also with the Fair Credit Billing Act. And FCBA requires that payments are credited promptly. If a payment was made and the lender didn't apply it correctly, then marked you as delinquent, that's also a violation. In short, FCBA gives you powerful protection if the issue started with bad billing or misapplied payments, especially on open-end credit. The Fair and Accurate Credit Card Transaction Act, or FACTA, is an amendment to the FCRA. It brought in new protections focused on identity theft and credit accuracy. Here's how it applies to a foreclosure and credit reporting. First, identity theft. If a foreclosure shows up on your credit report due to identity theft, meaning someone took out a mortgage in your name, FACTA gives you the right to block that info. All you have to do is submit a valid identity theft report. The bank is then prohibited from even reporting that account again. If they do, that's a serious violation. Second, negative info notice. Just like we mentioned under the FCRA, FACTA requires banks to notify you within 30 days of reporting. Just like we mentioned under FCRA, FACTA requires banks to notify you within 30 days of reporting negative info like a foreclosure. If they didn't send you that notice, that's a compliance failure regulators care about. Third, direct disputes. Thanks to FACTA, you can now send your dispute directly to the lender, not just the credit bureaus. And when you do, they're required to investigate it. If they ignore it or blow it off, that's a violation. So if you ever disputed a foreclosure directly with the bank and heard nothing, that could be a FACTA issue. Fourth, accuracy and integrity policies. FACTA forced lenders to have written procedures to ensure they report data accurately. That includes using standard credit reporting formats and fixing errors quickly. If a bank doesn't have those systems in place and they report a foreclosure with the wrong dates, statutes, or balances, they could be violating the FACTA. FACTA gives you more tools to clean up wrongful foreclosure, especially if identity theft or lender carelessness is involved. Finally, let's cover the Truth in Lending Act, or TILA. TILA was designed to ensure borrowers get full transparency and disclosure about terms of their loans. But in the context of a foreclosure and credit reporting, it provides some powerful protections most people overlook. First, disclosure violations. Lenders are required to clearly disclose the terms of your loan, including APR, payment schedule, and any potential penalties, upfront and in writing. If your lender failed to do this properly at closing, it could be a TILA violation. Why does it even matter? Because if the loan was originated with faulty disclosures, it could affect the legitimacy of the entire foreclosure process. And keep in mind, this is something that they have to prove. If they cannot prove that they sent it to you or gave it to you in writing, and remember, there's a short window of time. And so when you do the disputes, it's all about being tactical and strategic and diligent. Because when you can add up these disputes and you have experience, you can sort of predict the cards that they have or get a good gauge of what they're working with. And the key of disputing is to make them overlook certain things and then have a dispute later. But that's a more technical conversation. I just want to let you guys know, like in this video, we're going to go over a description of these laws, but it's not in their entirety. These are just the main things. But when I work with a customer, each customer is different, and so the strategies I would construct for them may be different than others, because we have the Fair Credit Reporting Act, we have the Truth in Lending Act, we have the Equal Credit Opportunity Act, we have the Fair Credit Billing Act, the Fair and Accurate Credit Card Transaction Act, and the Fair Debt Collection Practice Act, the 6 laws that I mentioned, but they can be applied in unique ways.